Welcome, ladies and gentlemen, to PDAC 2024 in Toronto. And now we have a very special guest, Joe Cavatoni from the World Gold Council. He's the Chief Market Strategist. And yeah, it's really the first time that I have a chance to talk to him. And yeah, really outstanding. Thanks for taking the time, Joe.
Thank you for having me. It's great to see you and great to be here.
Yeah, great to have you here. Gold, 2,817, it was an hour ago. We all love it. A lot of smiling faces here.
That's right.
Gold is something, a lot of people love for sure. Yeah, and the others hate it because, first of all, they don't have it. Then it's not moving. Then it's not doing what the inflation wants to do it. Yeah,
Sure.
But it is what it is. And the year 2024. Let's start with that.
Sure.
What do you think would be drivers for gold this year? Where do you see them?
Okay. So I want to start by talking about 2023 to lay the foundation for what we should be focusing on for 2024.
Okay.
2023 was a record year for gold. Now, you mentioned people like it and don't like it.
Yeah.
Most people like to have it. So gold as an investment in particular was a bit constrained over the course of 2023, and we expect that to continue into 2024. But pockets of very, very large demand, because gold is global and gold is consumed by all different types of consumers, kept the price performing extremely well, up about 15% for 2023. And we see that trend continuing as well. Those areas were retail, in terms of China, India coming on full time post-COVID in the form of jewelry and then also in the form of investment. But then also a significant amount of near record buying again from central banks, mainly emerging market central banks. Over 1,000 tons of gold again in 2023. And the landscape for that environment continues to be well positioned for that trend to continue, especially amongst the emerging market central banks, China, Poland, and others. So you're going to see that continue. Now we're going to be held back when people think about what monetary policy is going to look like, how monetary policy and fiscal policy will play out in the U.S., and how that's going to develop into 2024. And that's where we're getting some volatility in the price and also some headwinds on the upside. But we did hit a record, I think, today for the LBMA PM fix, which is an important number, not the only number to look at, but an important number when it comes to understanding how the market works.
Yeah, definitely. And I find it really funny that all those central banks are really buying now, are really heavy buyers. On the other hand, you hear in Europe, for example, from the European central banks, you hear, you don't need gold, it's not necessary. And then all of a sudden you see, they bought 10 tons, 50 tons, 30 tons here. And I say, why do they tell us not to buy? So it's always good to be a contrarian.
So we make a lot of information available about central bank activities in gold. And actually, we have all of that on our website. We have an annual survey we do, which is going to be published early summer. Now, have your audience keep an eye out for that, because it's going to be very telling about a number of factors. What I think the developed market central banks are saying is they might not need to add gold to their reserve portfolio. They probably already have a sufficient amount to diversify their portfolio appropriately with gold, for the example of the US and all the European central banks. But the emerging central banks, the emerging market and developed economy central banks, we would say that they are probably under allocated to gold, and they are actually diversifying away from fiat currencies or other sovereign-based assets and adding gold to their portfolios for various different reasons, managing their own inflation risk, managing a bit of their diversification risk, needing it for liquidity, and that's actually really what's driving it. And it's a 14-year trend that we've seen net buying, mainly from these emerging market central banks. So while it's hitting record levels, it's something we've been seeing for 14 years. So we hear the developed market central banks, but we also recognize that not everybody has that much, and we're seeing these banks bring it online.
Yeah, and they want more, definitely. And as you said in our pre-talk here before the interview, it's a super liquid instrument.
That's right.
And I was asking you before we started that interview, what is your opinion on, let's say, those, I call it funny market movements from time to time, when you see charts and presentations? In 20 minutes, the gold price dropped $40 and there was like $2 or $3 billion sold. And I think then to myself, why should you do that? Why do you kill the market? What is your view on that?
So I think that what that tells us is that there's probably two large commodities that are large enough for all the players in the ecosystem to participate. Those that want to buy it and hold it, those that want to invest in it shorter term, and even those that want to speculate it. When we talk about those gaps up and down, That's usually speculative flows that are stepping into the OTC market and also the transparent market. And you're looking at somewhere between 50 to $150 billion of volume a day on gold. It ranks amongst the top 5 instruments that you can trade every day. So you're going to definitely see these big moves. They're going to be fast and furious, and they're usually going to be the result of some form of catalyst by the speculators to say, for example, we may have heard over the course of the latter part of December that maybe the Fed's rate cuts weren't happening. You wouldn't be surprised to see that kind of a gap down in the price as people move to react to that, because they are doing those types of trades in the gold market because they can express their view there. So expect that volatility, particularly in times when things are still moving around rates, the Fed's policy, particularly. You're going to see the volatile movement in the price. But what you're always going to see underpinning it is that broad-based demand that's going to keep it moving up on its trajectory. So I'd say to you that it's not anything to be alarmed about. It just needs to be something that's understood, which is we might have a movement up or down. But $40 on a $2,000 gold price isn't crazy.
That's right.
And actually what you find is there are ready buyers that will step in and support, which is something we haven't seen in the history of gold. We've seen gap downs from investment dollars, usually pushing the price more. This time around, we're seeing the retail investment, we're seeing the jewelry investment, we're seing the central bank investment stepping in and holding that price firm. So that $2,000 mark is a really interesting number.
Absolutely. As you are also talking to all the producers in the world, what is your view, let's say, this year, next year, producing trends? Normally we say, like, I think the world gold production goes normally like 2%.
I think that's
an average probably.
I think,
What is your feeling?
So
because
we're
my
trying
feeling is the low-hanging fruits are all done.
Yeah.
It's getting harder and harder to really, get good mines into production and to maintain them.
Right.
Yeah, so what's your view?
I think it's a great question. You know, the World Gold Council is made up of 30 plus members that are the world's largest gold producers, but many of them produce more than just gold. So you're looking at a diverse universe of metals that they're working with. And I think what's interesting is that the production cycle will look to put that 2 to 3% of ongoing continual supply into the ecosystem. But the industry is facing an opportunity for a bit of consolidation amongst the larger players and actually some challenges in terms of funding new projects and greenfields. So I think it's an interesting space to watch. I think the capacity is there for continued growth to bring supply online. But I would also remind everyone that gold can be recycled. And actually, while mining is a component that's going to continue to fuel the upside demand, there's also the recycling side that will kick in. And when prices get a little bit higher, it tends to bring that type of behavior out of the different markets. So you might see less jewelry buying and more jewelry to recycling in a market like India, but you also might see that become a larger component. So what I'd say is the trend that we've been talking to about 2-3% production increase, likely to continue. Every dollar we are above the all-in sustainable cost is a good thing for the mining community. And I think what we can see coming out of PDAC, and it's, 10,000 plus people here, if not more, talking about that, maybe 30,000. I can't count them all, right? There's so many people, but it's a huge community that I think is looking to figure out what more needs to happen for more than just gold prices to move to kind of bring that whole mining sector back into the limelight and make it a little bit more exciting for everybody to invest in again.
Yeah, absolutely. What do you think was the reason that we saw in the gold triple top now at approximately 2060, 2080 was 3 times. We pulled back every time. Now we are at 2,100, let's call it 20, My breakout level is 2,180. Then I think we are going through. What do you think made the market every time not to go over it? Because the time to me is right. If we go back to February 1980, gold price 850. If we extrapolate that with a 3% average inflation rate, we should be already at 2,800. And that's just inflation.
Right.
Yeah, there's nothing in a surplus or let's say in a speculation to get security, insurance, whatever. What do you think is the reason that this has not yet happened, but maybe it happens now?
I think the biggest constraint or headwinds, as we put it, that continue to put that pressure on the upside for gold, why we're not breaking out as much, is that the mainstream investment in gold is the area of demand that needs to come back online. Now, the ETF market I mentioned previously, it's a small market, but it does give a good lens into the outlook of how investors are thinking about risk assets versus the type of asset, a safe haven asset that gold is. So they're looking at risk assets right now and saying, I'm confused, but I see opportunity, and it's a lot of money on the table with it. So I'm going to keep an allocation to gold, but I'm also going to deploy as much as I can to higher yielding assets. And that's what we're up against right now. So what we need to see in front of us is a clear picture from the monetary policy from the US that's going to bring rates down, and that's going to bring gold back into a large amount of investment demand coming online, particularly institutional demand.
Yeah.
Now, I talked a bit ago about retail investment.
Yeah,
So at the small scale, bars and coins, we see little pockets of success and little pockets of really interesting demand continuing to develop. But that institutional mindset will only come back when they can balance out how much gold should be in their portfolio against the risk assets that they're looking at right now.
Absolutely.
I mean, cash right now in the U.S. is yielding 5%. So
it's an argument. Yeah.
It's a
That's
challenge.
right. Yeah.
But what we do get often with investors is that they're not losing much of their allocation. They may be tapering it back on a dollar basis. They're holding it firm, but they aren't selling out. And I think in the past we had seen that. We had seen the lack of a diversification understanding for gold, but also geopolitical risks less likely to develop back in 2008 as an example.
That's right.
I think that here today we have a lot of other factors that might keep the allocation higher. Systemic events, geopolitical events.
Yeah.
Just, the political outcome in the U.S., which will lead to policy changes, which will lead to differences in how, geopolitics will play out. But that's not a 6-week thing. That's not a 6-month thing. That's a 2-year thing.
Yeah.
So, but it still keeps the allocation high.
Yeah, it's the only thing is with cash when you are in the US and the wrong bank, it does not help.
Well, funny, if you mitigate that by holding gold, you can prepare yourself for a bank failure, which I think right around this time last year we started to see one,
exactly.
Or 3, or maybe one including a Swiss bank.
Yeah, if you look at the world allocation of assets, I think gold is still something around 1%.
Yeah,
Like that,
it depends on how you want to look at the number or where you want to look, but I think firms have put out a number ranging between 1.5% to 5%. It all depends. We're on the lower end of those allocations these days, particularly when it comes to the institutional mindset. Again, simply because risk assets are the challenge for us in terms of keeping the allocations higher. But people are not selling it and just leaving it all together. They're actually just keeping it lower than it has been in the past.
What would you say as World Gold Council would be a healthy allocation in gold?
We'd probably say about 3 to 5.
Okay. Yeah.
Percentage.
I say always up to 10.
Well, I think it's hard to just put a simple number on it, but I wanted to give you a range where we talk to people. And if you look at the data, we can show with typical diversified portfolios, the maximum impact that it could have in terms of the overall risk-adjusted return impact to your portfolio. That 3 to 5% actually does well. The higher you go, depending on the mix of your portfolio, it could be better for you.
Yeah, absolutely. What's your personal price target for gold this year?
Well, we don't call the gold price, but I can tell you this. 2 factors are going to keep it on its upward trajectory. The central banks continuing to allocate, and actually the geopolitical risks that are on the horizon. So I wouldn't be surprised to see it well above where it is today by the end of the year.
Okay.
But we need to see the Fed make a move on rates.
Oh, we will see that in the second half, definitely. That's for sure.
You made that call, so I'm going to hold you to that.
I make that call. Absolutely. Let's talk shortly about gold and Bitcoin. Because very often you hear, Bitcoin, this is now the big competition to gold, and I want to go more in Bitcoin instead of gold, much easier to do, and I can do everything easily electronically. How do you see that? I mean, Bitcoin is for me something with 0, 1, and power. That's it. Gold, I have the bar or the coin in my hand.
So we look at the assets, and we are pretty clear in our position, which is that Bitcoin is a risk asset. Yep. It behaves like a risk asset, and the use cases are still developing. So if you choose to look at that asset and you're interested in the very volatile returns that come with it, both on the upside and on the downside, then move it into a risk bucket and turn back to your portfolio analysis and say, how much gold should I have to mitigate the risk of that asset being in my portfolio? We see them as completely different. And little things like saying there's mining in Bitcoin and there's mining in gold. You walk this room here and it is vastly different to a mining of a technology and a token. So it's completely
because I put out the plug in the mining farm, it's done.
It's a misuse of the term, but I'm not going to get into the debate about that. But what I would say is simply this. If you choose to put that risk asset in your portfolio, then maybe your 10% is a better allocation for your gold allocation to that portfolio because you need more of a buffer
Yep.
and you need more of that shock absorber in it. And that's exactly how gold's going to perform for you. So it correlates Bitcoin better to tech stocks and more like tech stocks versus gold, which correlates the way it does. The diversification benefits are there. Positive on the upside with equities as an example, and negatively on the downside. So we're doing well when you need it to do well. It's the right kind of diversification.
That's it. Super. Thank you very much, Joe. That was really great to talk to you about it. And I mean, we are both gold bulls, I would say, right?
I think we are, and it's great to be here. And thanks again
Super.
for having me.
Thank you very much, Joe. Yeah, ladies and gentlemen, there was Joe Cavatoni from the World Gold Council, the chief market strategist. And you heard it. I mean, we are both gold bulls. What can we say? We are very positive on this. And has not given me a price target. Maybe I can get that later from him when we have something to drink. But the thing is, really, gold will be much, much higher. That is for sure. And my personal target is for this year easily 2,500. I think this is absolutely achievable. And also in the longer term, the charts are calling for 2,800 up to 3,250 for maybe already next year. So we will see, but gold is the thing you want to have. It's insurance, it's security, and it's completely independent. And you don't have any counterpart against you. So check out also the World Gold Council. They're doing a great job in information. There's a lot of great information when you want to make your research on the gold markets. Use that. It's for free on their website. It is great work, great stuff. Thanks for watching us, and bye-bye from PDIC 2024.